Craig, what's up, buddy?
What's up, Brad?
Happy Thanksgiving, brother.
Happy Thanksgiving, brother.
I just want to mention, man, I'm so thankful for you, bro. You just,
I'm thankful for you too. I appreciate that, man.
yeah, you're a huge part of our business, man. And I think that we've grown, as individuals, as humans, but as a business, I think our business has grown so much over the last 12 to 24 months because of everything we put in process. And I couldn't be more
happy to be on the team.
Yeah, man.
And there's more growth to come, by the way. So
there definitely is, man. So I couldn't be more thankful for you and the rest of the people on our team. But also I'm very thankful for our clients, our loyal clients, and our loyal referral partners, those that we worked with over the last 12 months, but the people that we worked with over our entire career. So
very thankful.
Cool, man. So everybody, happy Thanksgiving. Thanks for tuning in. Today, we're going to do something different. Craig and I are hip hop fans. So for those of you that know about hip hop, you're probably familiar with the freestyle, the alphabet freestyle. So we're going to do something a little bit different this week. We're going to do our own version.
I'm not rapping or freestyling.
Yeah, you got to rap, man. You got to kick a beat. Can you beatbox? By the way, for those of you that don't know Craig, in his free time, he is the master beater. Like, he's got the whole setup at home, and that's what he does during his time off, is he makes beats. So
I'm definitely not rapping on Facebook Live. I can promise
you don't rap. You don't rap. You make beats. We know that. So for those of you that do rap out there that are starting your hip hop career, or
maybe one of these times I'll put one of my beats on the Facebook Live in the background or something.
Today would have been the perfect time. So. All right, so we're gonna rattle off the A through Z. Do something different today. So let's start with A, Craig. APR.
APR. So this is not to be confused with a note rate. APR stands for annual percentage rate, and basically it's the cost involved with the loan, your finance charges, in a percentage format that you pay over the year. So not just note rate, right? That's your interest rate, but other charges are involved with your loan. So you have an origination fee. You have other charges that are considered finance charges, like mortgage insurance. So the higher the APR, it means not only, let's just say you have a 3.5% interest rate and a 3.75 APR, that means that somebody that's offering a 3.5% interest rate with a 4% APR has higher charges, right? So it's a good indicator of cost over a year's time, but it's basically over the life of the loan, right? Finance charges over the life of the loan. So it's a good cost indicator in total if you're talking about looking at costs in general.
So in summary, guys, if you are comparing one lender versus the next, the best way to see where you're getting the better deal is to look at APR, because that's everything. It's combined. It's interest rate and certain loan costs that you're paying at settlement.
Agreed. Bank statements, Brad.
Bank statements. So we do review bank statements to determine that you have what is needed to close. So obviously, in some cases with a refinance, we don't require bank statements, but on most purchases, we are going to require that, because we have to see where the money for closing is coming from for your down payment and your closing costs. When reviewing bank statements, we're looking for certain things. Primarily, we're making sure that all the money in that bank account is in fact yours. So I think one of the biggest red flags is large deposits in bank accounts. When we see a large deposit, we have to ask for documentation to support it. So if you're going to get money from a friend, loved one, family member, whatever the case is, make sure that you can provide documentation. Talk to your lender first.
Another thing to add to that is reserve requirements. Some programs like investment property mortgage financing requires a amount of money left over after you spend money towards settlement fees and down payment, right? That's considered reserve funds, and 1 month of reserves is equal to 1 month of the subject property payment. So, and they also, additional money left over after settlement could also aid in eligibility. So that's important to know as well. Next thing is credit. Credit is super important. It's one of the main factors in getting qualified for a loan. Credit score is important in determining your interest rate. For conventional loans, it's a big part of what determines the cost adjustments, the loan level adjustments and pricing. for conventional financing. Certain loan programs require a minimum credit score. FHA requires, I believe 580 still in order to get maximum financing. It could be 575. I'm not 100% sure. But also lenders have their own credit score requirements. So although you might see guidelines or, different agencies offer programs at certain credit scores, it doesn't necessarily mean banks offer financing at a certain credit score. So knowing your credit score is important, but also how it affects you. Interest rate, eligibility for programs, those are all important. Derogatory events, right? Foreclosure, bankruptcy, these are all things that are a part of your credit that would affect your ability to get financing. Each loan type has its own time frame with regards to major derogatory events, foreclosure, bankruptcy, so forth.
Yeah, so I always tell people, C for credit. Credit stands for the ability to obtain financing. So a lot of times I tell people credit is going to determine if you're eligible or not eligible. Where D, the next letter, debt to income, that's going to determine how much you qualify for. So credit determines whether you qualify. Your debt to income ratio is going to determine how much you qualify for. So debt to income, DTI, is where we take a look at all of your debts, including this new proposed housing payment, and we compare it to your monthly income. It is a comparison on a monthly basis, and it's essentially going to determine how much you qualify for. Depending on the loan program and how you're going to occupy the home, it's going to determine, those things are going to determine how much your debt to income ratio can be. So typically you're in the range of like 40 to 45%. That's what most handbooks are going to say, but you can exceed that. I mean, we've done VA loans all the way up to like 76% because they have a different calculation. Kristen, we're not freestyle, but this is the ABCs. You hear me freestyle enough at home. So yeah, debt to income. We're taking a look at your debts versus your income to determine how much you qualify for. The next letter is E, employment history. Craig, talk about it.
So employment history, basically most loan programs are going to require a 2-year history. Doesn't mean it has to be with one employer. It can be a combination of employers. Within the 2 years, some programs require, if you have a gap of employment, that you have to go back even further than that. Self-employment history is usually a 2-year requirement. That's important, but employment history determines stability in the job place, and allows a bank to make sure that they're comfortable in lending you money, that you're able to repay the debt. Having a longer employment history helps, longer than 2 years, but at minimum, we only need a 2-year employment history.
F is for flood insurance. So flood insurance, guys, we have to determine whether your home's in a flood zone. We always want to make sure that our investment is protected. So on all loans, we do require homeowners insurance, but in some cases, flood insurance is required. We order certain reports called flood certifications. That's going to determine whether your home is in or is not in a flood zone. If it is in a flood zone, it is required that you have flood insurance just to protect us in the event and protect yourself in the event that there's a flood.
Just to add to that, certain loan programs require different types of flood policies, whether like a conventional loan requires private flood, not requires, but you can obtain private flood insurance. And then FHA loans have something that's called, you're required to get a policy that's protected by FEMA. I guess it's considered NFIP. So it's under that program label. Those particular programs or insurance policies usually are more expensive. So, just some added information regarding flood insurance with that.
All right. So before we move on, Yannick, what's up, brother? Denise, thanks for joining us. I hope you guys are ready for the holiday, and we appreciate y'all. So thanks for being here. Kristen, I always have to see you, but I love you. So thanks for being here.
So we're on G, gifts.
Gifts. So gifts, we're not talking about Christmas, guys. We're talking about gifts.
I think you're interrupting my turn, Brad. So
is it? I thought you were. Yeah, well, you took over the last one. All right, so gifts. Come on, Freestyle Friday.
Gifts are allowable for most programs, and it's usually when somebody is giving you money to assist towards down payment or closing costs. And who's an acceptable donor in this situation? You have family, right? Blood, related by blood, marriage. Certain loan types allow for a close friendship or a close relationship, and we have to document that relationship. We also have to document the transfer of funds from the donor to the recipient. And it's important that you know that we're going to get a transaction history from an acceptable donor to make sure that that money is in fact coming from the acceptable donor to the recipient, whoever's getting the mortgage. Gifts are not allowable on investment properties. You're up on homeowners insurance.
Homeowners insurance, we kind of just discussed this with flood. Homeowners insurance is going to protect the home as well. So we do require, as long as you're getting a loan, you are required to have homeowners insurance. And the coverage requirements are going to change depending on the property type. So like if you were buying a condo, the condo is protected under the association. They have their own coverage policies. You're going to only be applying for an insurance to pretty much cover from the walls in, where with your typical single family, multifamily home that's not in a condo association, you're getting a policy to cover the entire home, right? So regardless, if a loan is being obtained, you are required to have some type of homeowners insurance coverage. And the good thing is there's a lot of different homeowners insurance companies out there. We do have some preferred partners that we work with and refer to. And they're very good at what they do, but you can get different rates from different companies. So like anything, make sure you guys are shopping around or choosing someone that you know, like, and trust.
Investment properties. We offer investment property financing. This is a description of an investment property is something that you're not going to occupy, that you might be renting out. We go as high as 85% financing on single family homes. Multifamily homes for investment properties are 25% down. There's other different options. We're doing a loan for somebody for an investment property right now where there is no employment requirement. There is no employment income requirement, and the loan is qualified simply based on the rental income of the potential rental income of that property. So, really good type of loan. And in addition to that, in certain cases for investment properties, you're allowed to use subject property income to qualify. So a lot of people don't know that you're saying, well, I don't make enough money. And you're just looking at your finances instead of looking at what is the potential rental income for the subject property that you might be looking at. So that's something that we would be able to help you out with and see if you are eligible to purchase an investment property.
And two things, Craig, just so I check you on that. You said 80% or 85?
85.
Okay, good. Yeah, a lot of people don't realize you can buy an investment property with as little as 15% down. Your credit is going to determine that, because I priced out somebody with a lower credit score yesterday, and they did have to put down 20. But
yeah, the rates aren't great. You need mortgage insurance, and I feel like it only is specific to single family investment properties.
Yeah. So and then also, guys, we also get creative too. We just approved an investment property recently, and we underwrote the loan entirely based on the potential rent, based on what the appraiser said that the rent would be for that property. So we didn't have to look at any other income documents. Just keep that in mind. If you're thinking about buying a home and you think you can't do it, talk to us, because we could probably help. All right. Or at least get you on the right path.
Judgments for Jay.
J is for judgments. That's for me, right? So we talked about credit earlier, guys. We're going to look at your credit report. We're also going to look at certain things on your credit report, which is, public records and collections, judgments, things of that nature. So you want to make sure that you have your judgment satisfied prior to buying a home. Now, with a refinance, it typically doesn't come into, or no, wait, with a purchase, never mind. Forget I even said that. I'm thinking about something else. But either way, we're looking to see if there's any filed judgments against you, public records. And if there are, in some cases, you will have to satisfy them. Actually, in most cases, you will have to satisfy them. But we do a thorough review of your credit at the initial application during the pre-approval process. So if judgments are found at that point, we're going to discuss them with you. There are some cases where they don't show on your credit report, and they'll come up during the title search, which can be later on in the process. So if you're aware of judgments that might not be outstanding. If your lender's not bringing it up to you, then it might make sense to bring it up to them because it will come up in the future. Chances are.
I mean, I would think you get served paperwork for judgments, just like any lawsuit. So you're most likely, if you were served paperwork for, to be scheduled to be heard in court because of a collector, and usually that's what judgments are for, is somebody wants to be awarded a certain amount of money for services or money owed to them. You should be able, to know or hold on to those documents so that if you do buy a house, we're able to quickly identify whether it's an issue.
Now, in some cases, and correct me if I'm wrong, Craig, because you're doing the consultations these days. So when buying a house, in some cases, the title company's not doing a judgment search. We don't require that. So there are times when it can kind of fly under the radar. So as long as it doesn't show on credit and a buyer judgment search isn't required, then you could essentially close with having open judgment.
And you just got to be, that's possible, sure. And you just got to be aware that, any judgments that you have follow you and attach itself to the property. The reason behind that is because you don't have ownership in the property. Once you have ownership in the property, then the judgment follows you. And then, if you were to refinance your house or sell your house, that's going to come up in a search. And anytime you're selling or refinancing, that's when you're going to have, 100% of the time have that search, and those judgments would have to be satisfied in most cases in order to move forward with the sale or refinance of a home.
But like everything, you always want to plan for worst case scenario, not best case scenario. So that was just a little tidbit I added there, but you don't want to count on not having a buyer search done. So let's move on. L is for LTV.
LTV stands for loan to value. So it's basically the percentage of your loan amount compared to the purchase price or the appraised value. And this is important in some cases, right? Because if you're putting down 20%, right, that means that you have an 80% loan to value. And in a conventional loan, an 80% loan to value may mean that you don't need mortgage insurance, right? FHA allows you to borrow 96.5% of the purchase price, right? That means that you're putting toward 96.5% is what we're issuing for financing. 3.5% is what you're putting down as a down payment. 3.5% plus 96.5 equals 100%. So it's just the percentage of your loan amount compared to either the purchase price or appraised value. LTV also is important when talking about loan level adjustments and pricing for conventional financing, right? The better your credit score at a certain LTV, in most cases, a lower LTV could lead to lower cost adjustments, which leads to better interest rates. So LTV is important for a lot of things, but just in case you ever heard a mortgage guy talk about LTV, you kind of know what that is now.
Correct. Awesome. So M is for mortgage insurance. I guess I'll take that one. Mortgage insurance. Mortgage insurance is required in most cases when you're not putting 20% down. Now we do have some investors lined up now that you can do as little as like 10% down and not have mortgage insurance, but you're paying for it one way or the other, right? Because those investors typically have slightly higher interest rates, because I'm speaking specifically about like non-QM products, right? But the reality is, if mortgage insurance, whether you're doing a government insured loan, which is like the USDA, a VA, or an FHA loan, the government imposes that, requires it to get their funding, right? What up, Dan? And with conventional loans, they have what's called private mortgage insurance. So like you said earlier, we could do an investment property with as little as 15% down. In that case, they would have to have mortgage insurance. Or for say first-time home buyers or people that meet the home ready requirements, you could buy a primary residence using conventional financing with as little as 3% down. But in this case, mortgage insurance would be required. There's two different types of mortgage insurance. There's single paid and there's upfront. And in some cases, you pay a combination of both, right? But a long time ago, it was required that you had to put 20% down to buy a home, which is what created that misconception that people have that they need to put 20% down. But all of these government programs came about, these private mortgage insurance companies came about to allow people to buy a home with less than 20% down. Essentially, you're paying the mortgage insurance to cover and protect the lender. So the lender's willing to go to a higher loan to value, like we spoke on the last letter, if you have mortgage insurance. So the next one is N, standing for non-occupying co-borrowers. Craig, talk about it.
I think that this is common, and most loan types allow you to have a non-occupying co-borrower. So sometimes you might need help in eligibility for certain types of loans. A non-occupying co-borrower, like a parent, like a relative, might assist you in qualifying for a loan. A lot of questions that we get pertaining to that is, what's the responsibility of somebody that's not occupying the property, but just wants to help somebody qualify? You're purchasing the home as a non-occupying co-borrower. So if your parent is going on a loan and wants to help you qualify because you're, just starting out your career, you got student loans, and they just want to get you moved into a house and make a good investment, your parents are obligated to buying that property, so to speak, the same responsibilities that you have as being the primary occupant of that property. It's going to show up on their credit. If you miss mortgage payments, it's going to reflect on them as well. They're responsible to pay, equally responsible to pay the payments, even though they might not be making the payments. And sometimes non-occupying co-borrowers are helpful not only for income purposes, but for credit purposes. Maybe you have a lower credit score, and the combination of you having a lower credit score and a higher credit score from the non-occupying co-borrower might assist in the eligibility. A lot of our loans, most loans, I would say, that are offered to the public have to run through an automated underwriting system. So these systems look at the combination of credit scores, body of credit, and also individuals like non-owner occupants that are going on the loan that might have strong attributes that'll help your eligibility. So it happens a lot. Main points are that, somebody that's, even though somebody's not occupying the home, they still have equal responsibility in the mortgage. So that's non-occupying co-borrowers.
So the next is O for occupancy. I'll take that one. Occupancy, there's really three types, right? You're either buying a home to occupy it as a primary residence, you're buying a home to occupy it as a second home, or you're buying a home to not occupy at all, and it's an investment property. So there's three ways you can occupy, or should I say not occupy, a home. And depending on your occupancy type for the loan that you're applying for, it's going to determine interest rates, how much you have to put down. There's also other qualifying factors. So just keep in mind that when applying for a loan, we're going to look at it differently if you're buying it as an investment property versus a primary residence. A second home, you can't be living in Delran and buy a second home in Willingboro. Nobody's leaving Delran to vacation in Willingboro. So it's got to make sense, right? So a second home would be like in the Poconos, in Vermont, down the shore. Like it's far enough of a commute, and it actually makes sense that you're going to be living in it as a second home. Now, also in the past, I've had loans that we got approved that we called a second home, and it wasn't necessarily a vacation home, but it was another home that they resided in. Maybe you have a person that works in Philadelphia and their primary residence is in Florida, so they might come to Philadelphia a couple times a week, a month, a year, whatever the case is, to live in that home for work purposes. So it just has to make sense, and it can't smell, right? We always do the smell test, as I say. So those are the three types: primary, second homes, and investment properties. The next letter is P for points. Craig, why don't we talk about that?
Points usually are indicated by percentage of the loan amount. So it's a charge from the lender to a borrower for, and it's equal, let's just say 1 point is equal to 1% of your loan amount. And typically in what the normal reason behind why you might use points or want to pay points as a borrower is that you can pay to get your interest rate down. They're called discount points. So whatever the prevailing rate is, let's say it's 3.5%, but you want to get a lower interest rate. To offset those costs, a lender would, to lower the interest rate, a lender would say, hey, you could pay a certain percentage of your loan amount to get your rate lower, maybe to 3 3/8, to 3 1/4. Typically, in my experience, 1 point would usually yield 1/8 or 1/4% better in interest rate. And it's not always a good thing to pay points because there's a cost factor involved, and the difference between what the standard rate offered is without points and a rate offered with points is going to yield you a monthly savings, right? So there's a cost recovery period. And let's just say it takes 5 years to recover the cost of a point, even 4 years. If you plan on staying in the house a short time, this is just your starter home, and you plan on in 5 years selling that house, then it might not make sense for you to pay a point to get a lower interest rate just to save $30, $40 a month. But for the long term, yeah, if you're carrying that loan out for 15 years, 20 years, and this is your forever home, or it's an investment property, sometimes it's worth taking a look at that. And we do a total cost analysis to kind of show you those options and go over short-term, long-term savings based on your goals. So points can be a good thing, and sometimes they're not, but it is an option if you decide to choose so, and it's good for certain situations.
And there are in some cases, I mean, obviously we're not accountants, but in some cases there are certain tax advantages. So when you pay that point, it is considered prepaid interest. Now, obviously there's been a limit on, what you can write off and stuff like that. So don't pay points because of what I just said there, but just keep it in mind that if you do pay points, it's something you want to show your accountant because you might get a benefit out of, or at least recoup some of that cost and tax advantages. So the next one is Q, qualifying rental income. I'll take that. But Craig, I forgot more than a lot of people know because I haven't been in a loan in a long time, right? So you might have to help me here. But qualifying rental income is how much rental income we can use as qualifying income. So Craig had mentioned this earlier. When buying investment properties, we're allowed to use a percentage of what the appraiser might indicate that rent is as qualifying income. Now, for a long time, Craig, I think the qualifying percentage, the ratio we would use to determine the qualifying rental income was higher. But then after COVID, certain restrictions were put in place that reduced what we could use. You might have to elaborate on that because I want to say it's been a long time, man, but I think like conventional was 75% of the rent and FHA might have been like 85, if I remember correctly.
No, it's they're both 75, and I feel like that's changed back to normal now. So it's still 75% rental income. If you're purchasing an investment for the subject property, you can use 75% of the potential rental income. But there's certain scenarios where that might change, right? If you're vacating a primary residence, they'll allow you to use 75%. And this is what I've experienced recently, 75% of a lease. You have to have a lease in place prior to your first mortgage payment, a security deposit. But usually the marker is 75% of a lease for a vacated primary residence. We're talking about the subject property, buying an investment, or maybe it's a primary residence, multifamily, right? FHA still allows you to use 75% of the rental income. And that's all based on the appraisal, right? Appraisal of the subject property, the market rent analysis. Appraiser says that the rent is $1,000. That means that you can use $750 towards the qualifying rental income. So each situation is different. We can sit here forever and talk about those different scenarios, but the bottom line is that you are able to use potential qualifying rental income towards your eligibility with investment properties, with primary residences that have multifamily components attached to it.
Yeah, and I think it's awesome because like a point that you mentioned that a lot of people don't know about, even realtors, that you can actually use the potential rent from a property that you're vacating. And all we do is get like a special type of appraisal where it's like a drive-by appraisal and they give us like a rent analysis for that house. So like, keep that in mind, guys. Like if you have a house and you don't want to sell, which is more people want to sell their homes in today's market, but in some cases you can rent your property out and use the potential rent to help qualify for the next property. So keep that in mind.
Great.
Craig, you kind of took over that one.
But I can talk about renovation loans.
I want to talk.
Okay, good.
All right. The next one is R for renovation loans. And I just wanted to steal this because I just love renovation loans so much because number one, I do all the business development here. So I don't really have to deal with them as much as Craig does. So he's doing all the hard work. But right now, guys, in this market, it's so hard to find a house. And this could help you find your perfect dream home, right? Because everybody is interested in the same homes, right? And everybody is not interested in the same homes. So you might find that diamond in a rough that is just a little bit beat up on the outside. Maybe it needs a new kitchen, a new bathroom. The reality is FHA offers a program called the 203K loan, and Fannie, which a lot of people don't know this, even a lot of realtors. I just talked to somebody earlier, they weren't aware of this, but Fannie offers a program called the Homestyle, which is very similar to the 203K. And the gist of both of these programs is that you can get financing up to a certain percentage of the acquisition, which is what you're buying the home for, plus your renovation costs. So for example, if you're buying yeah, I do love the 203K, Chris. So if you're buying a primary residence, you can use the FHA 203K, make a 3.5% down payment of the acquisition plus renovation. So if you're buying the house for 100 and you need $50,000 in renovations, then you're basically putting down $5,250 to buy and renovate that home. And those are simple numbers. There's obviously some costs involved that get financed with the renovation loan, which we could talk about when you call us to go over your situation. But that's kind of how it works. The home style, it's a 5% down payment requirement for a primary, but then you can also buy second homes and investment properties as well. Right. So depending, like we said about occupancy before, depending on how you're going to occupy the home, that's going to determine how much you put down. But these are very good programs, and they can also be used to refinance your home. So if you have a home and you're looking to make renovations and maybe you don't have the equity that's needed to finance or fund all those renovations, if you're living in a primary home, for instance, you pretty much only need 5% equity all said and done to do a renovation loan on a home style. Or with the FHA, they have a different calculation. It'll go up to 110% of the after completed value. A lot of information here, guys. The reality is, if the main thing is that if you want to use a renovation loan, it's a great product and we're experts at it. I'm all kidding aside, like, I do know a lot about the program, but Craig's the consultation guy, so he can definitely answer all your questions and get you qualified.
I will help you with that.
The next one, student loans. The S is for student loans. That's on you, Craig.
We see this a lot. So every loan program has different requirements with regards to how they count student loans against you as far as a liability is concerned, right? A lot of times you're a student, you're not paying that debt back yet because maybe you're in school or it's in deferment or forbearance. So most loan programs require that we count a certain amount of or a percentage of the balance of those student loans as a liability against you, regardless if you're in repayment or not. Some loan programs, like conventional loan programs, if you're paying like $20 a month on a $10,000 student loan, we'll accept that as the payment to determine your debt to income ratio. But there's other loan programs that have different requirements. If there is no payment showing up on your credit report, FHA requires now what used to be 1% of the loan balance towards your debt to income ratio is now 0.5%. So that's big. If you're in the market to buy a house, and last year, I mean, this only happened recently. 2 years ago, you couldn't do anything because your student loans were in deferment and they're counting 1% of your student loan debt against you. Towards your liabilities. You may be able to qualify now because they just changed this recently to 0.5%. Freddie Mac, which is an agency that purchases conventional mortgages on the secondary market, they only charge, or they only will count 0.5% of the balance against you for a liability. Fannie Mae, I feel like, is the only one that hasn't kind of changed gears with this. They still will count 1% of your loan balance, student loan balances against you as a liability. So we kind of know the ins and outs of this, and we would kind of direct you the right way on what loans would work if you have student loans. But if you were in the past, you had trouble qualifying with an FHA loan, and that's the loan that was right for you, maybe it's time to explore that option again because you might qualify for more money this go around.
I lose you?
No, I'm here. Can you hear me?
Right. You just stopped real quick. So, all right, next is T for tax returns. I'll take that one. So tax returns are an income document that they're required in some cases they're not. So it really comes down to what type of income you make. So typically speaking, if you're a W-2 wage earner, we're only asking for W-2s and pay stubs. In the event that you're self-employed or you have other type of income, maybe from investments or investment properties, then we will have to verify that income through a tax return. So we're talking about tax returns today because if you're looking to get pre-approved for a loan or refinance a home, just make sure you have your tax returns available because there is a good chance that they will be needed. Unless, of course, like I said, you're a W-2 wage earner, right? In some cases, if you're a W-2 wage earner, we still need tax returns. And that's if a certain percentage of your income is bonus or things of that nature, right? I think it's bonus, right, Craig? Are we still requiring tax returns if it's 25% or more, if their income is 25% or more commission, I mean?
I don't know the answer to that. I don't think so. No, because if you're a wage earner, then we're going to do a verification of employment. We get breakdowns of commission based on the verification of employment. You know, like
you know what it was? It might have been back when we had when
you're talking about 2106 unreimbursed.
Yeah. So now that unreimbursed employee expenses aren't required anymore, so maybe that's the case. See,
No.
it's been too long, man. I forgot more than most people.
Right. Don't worry. I'll take care of that. But, you know, just to add to what you're saying about tax returns, if you're a business owner, maybe you don't file separate business returns because you have a sole proprietorship, right? You file a Schedule C in that case, right? If you're a contracted employee for a company, you work for Uber, you work for Lyft, you run a small landscaping business, you're a real estate agent. A lot of realtors file what's called a Schedule C as a sole proprietor. That's going to be on your personal return. But if you are, you know, you have an S corporation, a standard corporation, or an LLC, not all LLCs will, you know, require business tax returns, but most of those types of business entities will require their own separate return. So it's important to know that if you're applying for a loan, you know, what types of taxes do you file? Do you file just your personal returns, your 1040s, or do you file 1065s, 1120s, right? Those are your business returns, and those would have to be reviewed and looked at if you do want to use business income to qualify. So just, and another thing to touch on about that too, not to mention, is if we do require tax returns, a lot of people don't know that if they owe money to the IRS, that's something that you want to identify with us or your lender right away. Because if we're required to look at tax returns, we're also required to look at, do you owe money to the IRS? That's going to show in the spot where it normally says, hey, I'm getting a refund this year, or I owe money. We're going to want to know, okay, are you on a payment plan with the IRS? Have you paid the money for your previous taxes that are owed? So it's important to kind of understand that we're going to, if we are needing tax returns, we're going to look at everything involved that might affect the repayment of the loan, including IRS liability.
Cool. Great information, Craig. So U is for underwriting. You want to talk on that?
Yeah. So I like
you always have like a thing that
I like to use the court analogy for underwriters. So we represent you like we're your attorneys. We prepare a file, we try to build your case, right? And we want to prepare the file so that the underwriter, who is the judge, is going to rule in favor of you getting a loan, right? So the underwriter is licensed to approve and commit to lend you money on behalf of the bank. We are just there to facilitate your file to get to that person and approve and commit to lend you money. So it's important that you understand that we want to know everything, right? We're going to make sure that we box this case together so that the underwriter is going to rule in favor of you. Now, we also have to follow rules, right, and guidelines. We understand the law, right, in quotation marks, and the underwriter has to rule with the law in mind. But we understand what we want the judge to see and what we want the judge to know, so that we give you the best chance to get the judge, or underwriter in this case, to rule in your favor. So it's important to have good loan officers, good attorneys, and a good team, right, your paralegals, so to speak, to help you facilitate that ruling in favor from an underwriter. So I feel like that's a good analogy in terms of how we look at our business and how we want people to understand how an underwriter works.
So like another way to look at that analogy is, guys, if you're going to trial or you've watched TV that involves people going to trial, you don't want a public defender. They're cheap, right? So they're going to get you the best rate, right? But they might not get you there. They might not, the judge or the underwriter might not rule in your favor because you're picking the wrong person to represent you. So keep that in mind.
And we've won a lot of cases. So
we have. We've lost hardly any, man.
So verification of employment.
Verification of employment. So the entire mortgage process is based on verification. So we verify everything. We validate everything. When you get your pre-approval initially from us, we're validating all your income and your assets and your credit up front. One of the things that we do once your loan goes into process is that our processors are going to verify employment. So they're going to send forms and requests to your employer to make sure that you're currently working, and we're going to get that from them. But it's also going to break down your income so that we know that what we're using to qualify you is in fact what you're being paid by your employer. And there are cases when the verification of employment comes back and it's much different than what you provided to us, right? So we are going to verify everything. So make sure if you guys are supplying documents to your lender that you're actually working, because we're still going to check and verify employment all the way up until the very end of the process. I mean, we've had people, and I hate to say this, but we've had people, Craig, right, where like their closing was that day or the very next day, and then we ordered a last minute employment verification to make sure they were still working, and learned that they were no longer working there.
They quit their job a couple of days ago.
Yeah. So, I mean, look, we usually get it done as long as the people go back to work, but it definitely creates a wrinkle in the process. So just make sure you guys are being open and honest with your lender, because we do order a lot of different verifications, right? The next one is W, which is waived appraisals, or really the term is appraisal waiver. But that starts with an A, obviously. So Craig, let's talk about appraisal waivers.
I think this has happened a lot more since COVID. I don't know why, but there was a point in time where I don't remember getting appraisal waivers, but now these agencies, and let's be clear, this is more common with conventional financing, right? You don't see a lot of appraisal waivers with VA loans, probably none, FHA or USDA. This really only kind of gears towards conventional financing. A lot of what we see with appraisal waivers is going to be regarding rate and term refinances. And what that means is that you're just taking a loan out to pay off your existing mortgage plus settlement fees. And the purpose of that refinance is to lower the interest rate or lower the term, or a combination of both, from a 30-year to a 20-year, from a 20-year to a 15-year, going to a lower interest rate. That's rate and term. We're seeing a lot of appraisal waivers. And what that means is we input a value on the application. We run that application through an automated underwriting system, and that automated underwriting system is going to say, yes, that value that you put in is acceptable without having an appraisal, right? This does a couple things. One, we don't need to charge you anything for an appraisal, right? So there's no out-of-pocket expense if you're, refinancing your home. The other thing is, if that appraisal value that we enter is acceptable, maybe, if an appraiser went out to the property, the value might be lower than what the automated system is accepting. That value might be the difference between you needing mortgage insurance and you not needing mortgage insurance. So having that waiver is awesome in a sense, because not only does it save you money in your pocket, but it could be the difference between you having extra costs in your monthly payment for mortgage insurance and not. Other thing I might add to is that we also receive appraisal waivers for purchases. Why is this a super awesome thing? Because in the market that we're in, if you're buying a house, sometimes you might have to overpay, and you don't know whether that house is going to be worth a certain amount of money. We have a client right now that there's a clause in the contract that they're willing to pay X amount of dollars over the contract if the house underappraised below the sales price. So we have an appraisal waiver based on the value that we've inputted, which is equal to the purchase price. There's no appraisal requirement. So this buyer is willing. I mean, obviously you have to be willing to pay the amount on the contract. So if you're willing to pay that amount, then you don't have to worry about the house coming in lower and you making up the difference, because the bank is only going to give you financing on the lower of two numbers, the purchase price or the appraised value. So if you're a real estate agent and you have a client that's, check with your lender to see if they get they're qualifying with an appraisal waiver, because that could save you headaches later down the road and costs at that matter.
Yeah, and it also, you know what, that's a great point you brought up, but it also, what it comes down to is, are you working with the right lender? I mean, we'll run it through the desktop underwriter, which is Fannie Mae's underwriting system, but then we'll also run it through LP, which is Freddie Mac's underwriting system. And there's times where you get an appraisal waiver from one system and not the other. So you always want to make sure you're double checking both systems. So keep that in mind, guys. Work with the right lender that lenders that are going to do the due diligence. All right, moving on. The next one is X for extraordinary service. And we know how to spell, guys. I will say one thing. We know how to spell, but we obviously don't know the alphabet because we skipped K. And we were about to skip Y, Craig, because we didn't have it. So just so you guys know, K and Y we skipped. All right?
We did skip K and Y.
Yeah, and K, we're just going to really quick, I'm just going to let you guys know we didn't really skip it. We're just not going to explain too much. K stands for kick butt because we're a kick butt mortgage team, and Y stands for you because we do it for you. We want you to have extraordinary service, right? So everything that we've built our business on is to create a referable experience. And in fact, that's part of our vision statement as a lender, is that our team, that's what our entire team is focused on, is creating a referable experience. Because my definition of a successful transaction is to have asked for and referred or received a referral during the process of getting somebody a loan. And the only way that somebody's going to be willing to refer their friends and family to you is if they have that wow moment, right? So that's pretty much it, guys. For X, we offer extraordinary service. We're always here for you, and we want to make the process as seamless and as transparent as possible. Plus, at the same time, close you on time and get you great rates and fees. But that's expected out of every lender. Did you want to add anything to that, Craig?
No, I just think that we're thankful for our clients. I feel like the difference between us and maybe some lenders is that we care. Things can happen during this process. We all know that, but we work hard regardless of the loan size, regardless of the credit score, who you are, where you're from. I feel like we treat everybody the same. And if there is an issue, we work hard to resolve that issue. And we want to make sure that everybody's taken care of. We don't want anybody to leave angry. It's sort of like, it's like a family. And that's how we treat our team. That's how we treat our clients. And we're just super appreciative, and we want to help as many people as we can. And I feel like that's a big part of why it's an extraordinary service from our part.
Yeah, I agree, man. Well said, Craig. So the last is Z. We're going to wrap it up here, guys. There was no beat. Craig's going to bring his beat making machine on the next alphabet.
Maybe on the next time, but you're going to talk about Zillow because you know more about what.
Yeah, let's just talk about. Let's end it with Z for Zillow. And look, I don't want to bash Zillow. They're an amazing company, and I'm a huge geek when it comes to marketing and advertising and online funnels and lead capture and follow-up, and they do it well, right? But the one thing that we all know is they failed recently with their whole, buying homes department. They were getting into that. And the reason I want to bring them up is not to bash them. I have a lot of respect for them, but to make it known, because we're thankful for our referral partners, guys. You have to work with people that know your market. And because we're so thankful for our referral partners, we know some realtors that are very good at what they do. And we know different realtors in different markets, right? And if they can't service a market that you're looking in, they know realtors in different markets. So the goal is to work with professionals, people that know the market. So if you're looking to buy a house or sell a home, don't just go to Zillow, don't just go online. Find somebody that knows your market and is good at what they do. And if you need help with that, if you need us to refer you to someone, feel free to reach out, because Craig and I have been doing this, Craig for, I don't know, almost 20 years now, myself 12 years. So we have a lot of relationships in this business that we formed over the years. So if there's anything that we can help you guys with, whether it's finding a real estate agent, finding an insurance agent, a CPA, a financial advisor, an attorney, whatever the case is, feel free to reach out to us. We're here to help. Craig, I'm just going to say it again, man. I appreciate you, man, because I'm very thankful for you because I learned a lot from you, man. I came into this, which most people don't know. I came into this business in 2009, which was probably the worst time to get in the mortgage business. And you kind of pulled me under your wing, man. You taught me a lot of things that I didn't know back then. And over the years, I've taught you some, obviously, kind of made up for it. But, I owe a lot to you, man, and to my cousin and your Uncle Joe for getting me into the mortgage business at a shitty time. But, I learned a lot, man. And I think that the sky's the limit, bro. And, we're doing a very good job servicing our clients and our referral partners. And I couldn't make it happen without the team and without you, man. So I appreciate you, brother.
Yeah, and I appreciate you, man. I'm thankful for, everything that we got. I'm certainly thankful this year that we can have Thanksgiving at a real house and me not being isolated. And I'm sure a lot of people are feeling the same way, is that they're happy to spend time with their family. So super awesome. I'm happy for, just to be able to have Thanksgiving this year. So a lot of people feel the same way. And I'm thankful for everybody watching this video, and hopefully they're going to have a good Thanksgiving.
Cool, man. Well, listen, I think everybody, whoever is watching this, their ears are bleeding at this point. So I think we've said enough. I'm ready to get this holiday started. So if my team, if you guys are watching this and you're still working, get your stuff done and get home and enjoy the rest of the week with your family. That's the unofficial, official. It's time to check out. All right, brother. Thanks everybody for watching. Happy Thanksgiving. Eat a lot, drink a lot, spend time with family. Talk to you guys soon.
Take care, guys.